Welcome to the 3Edge Week in Review for the week of July 12th. I'm Fritz Folts, Chief Investment Strategist at 3Edge, and with me today, once again, is Steve Cucchiaro, President and Chief Investment Officer here at 3Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing how the post-pandemic world of the global capital markets is turning out to be unlike anything that markets have ever seen before. We're all living in Jay Powell and the Fed's grand experiment, and it's critically important for investors to understand this extraordinary current environment. Before we get into that, we'll take a look at the activity in the global capital markets. Equity markets in the US were mixed for most of the week. They were up and they were down, but they continue to hover around record highs. This week, investors were focused on Fed Chair Powell's semi-annual testimony to Congress. In addition, this week's report on the Consumer Price Index showed that prices increased by 0.9% from May to June of this year, exceeding forecasts and providing the largest monthly increase in CPI since 2008. In spite of this larger anticipated increase in consumer prices, investors still seem to be of the mind that the Fed will remain accommodative until there is more certainty around the strength of the economic recovery from the pandemic. In his prepared remarks prior to his congressional testimony, Fed Chair Powell once again stated his belief that the current uptick in inflationary pressure would fade later in the year, and that the threshold for altering the Fed's $120 billion of monthly debt purchases was, and I quote, a ways off. In spite of the good news on the economic front, investors are concerned about the potential impact of the spread of the Delta variant of the coronavirus, particularly in states where the percentage of vaccinated individuals remains low. And concerns about a resurgence in coronavirus cases are playing a part in the conversations that investors are having about whether the US has already experienced peak growth as it rebounds from the pandemic, and this could certainly call into question the current valuations of the equity markets. So now let's shift our attention to today's topic, the Fed's grand experiment, which refers to the extraordinary monetary policy response by the Fed and other of the world's central banks in response first to the financial crisis in 2008, and then it was taken to an even more extreme level during the coronavirus global pandemic by the central banks. With the onset of the pandemic, it became almost a medical necessity to put the economy into a medically induced coma, shutting down large swaths of global commerce and forcing people to remain sheltered at home. The pandemic was a human tragedy for sure on a global scale, and the extraordinary response from governments and central banks was appropriate. However, the global economy and the capital markets, in fact, each of us, have been dramatically impacted by the Fed's extraordinary monetary policy. The Fed has created a vastly different world in the markets, and it's important to seek to understand where we are and where we may go from here. So this is where I want to bring Steve into the conversation. And Steve, perhaps you could speak to the world that the Fed and Jay Powell have created, that we're all living in, and what might this mean for the markets going forward?
Well, Fritz, I agree. And if there's one thing I want to express, it's the idea that these are not normal times, not even close. So over time, the Federal Reserve Board and other central banks, in an effort to support the economy or the markets, they create reserves out of thin air. And with those reserves, they use that money to buy market securities and to try to boost the economy and the markets. And this has happened over a century at a time. And over the last century, if you add up all the reserves that are sitting on the bank balance sheets across the world, you get $28 trillion. So that's a lot of stimulus that's been created over the last 100 years or more. The really surprising part, and why we call it the grand experiment, is that almost half of that, or over $12 trillion, has been created in just the last 15 months. It's no coincidence that during this extraordinary expansion of reserves, or what some people call money printing, the US stock market, as an example, has gone up 70% over the last 15 months. And that is in the 1/10 of 1% category of occurrences. So these are very much not normal times. Now, some of the results are other extremes. We have, over the last year or so, we've seen the lowest interest rates that the world has ever seen in history. In the US, the short-term rates are close to zero or at zero. Overseas, some of the rates are actually negative. This has encouraged lots of borrowing. Governments are now more indebted than ever. Corporations are more indebted than ever. Margin debt, which are investors who borrow money to yet buy more stocks, is at all-time records and exceeding periods in the past where we've seen market peaks. Is another example. For the first time in history, just this week, the yield on junk bonds, which means you're lending to companies of low credit quality, are actually not even at the rate of inflation. They're below the rate of inflation. That's never happened before. So these are truly extraordinary times, and we should all realize that we are all part, and the markets are part of this grand experiment that's never happened before.
Excellent. So one of the major changes that has impacted the markets as the world emerges from the coronavirus pandemic is the Fed's dovish response to the increases that we've seen in inflation throughout the economy. And how and when the Fed responds to inflationary pressure is referred to as their reaction function. And once again this week, Chair Powell stated that rather than rely on forecasted increases as a basis for tightening policy, as they have done in the past, the Fed now intends to wait for inflation to actually rise above its target in order to be sure that the economy is all the way back from the economic challenges brought on by the pandemic, and in particular, that the economy has returned to full employment. And this stance reflects a Fed that certainly seems to be more tolerant of higher inflation than they have been in the past. And so my question is, what are the potential implications of this shift in the Fed's reaction function?
So this is another sea change, and we could say that this is an important part of the grand experiment. Ever since the Fed was created in 1913, there have been a series of inflationary cycles. And at each inflationary cycle, the Fed, realizing that it takes several months for any actions that they put out to actually affect the economy and to restrain inflation, they always try to get a bit in front of the inflationary problem. So they always try to anticipate when inflation might grow, and they start to restrain the system or start to tighten in advance. Having said that, even though that's been their policy, almost every time they've been late. They've been behind the curve, and then they've had to ramp up interest rates even faster because they had to catch up being behind the curve, and then that caused a big downturn. So what's so different this time is that they're not even trying to forecast when inflation might go up in a big way. And they've come out openly and said, look, we're changing our policy. We're going to ignore inflation. We're going to let it run up above our previous targets. And we're going to wait until employment gets to be truly low, and not just the average employment rate, but the employment rate of all the sectors of the economy. And we're just going to assume that inflation will come back down. So we've never had a Fed policy like that. And if we were to pull, we were able to pull all the past Fed chair over the century, they would all be deathly afraid that the Fed is way too late and that we're going to have a more serious inflation problem. So this is a sea change, and time will tell.
Wow. All right. So if as investors we're all living in this extraordinary grand experiment from the Fed and other central banks, what should we do as investors in order to protect ourselves and even succeed in such an extraordinary environment?
So just this week, Chairman Powell testified in front of Congress and got lots of questions about inflation and unemployment. And he made it very clear, and he reinforced the idea that the Fed is still far away from making any changes to their extraordinary stimulative policy. And they are creating reserves at the rate of $120 billion a month, as you mentioned, which is at the rate annually of $1.4 trillion per year. And while they continue to do this, this does create fuel that could continue to drive the markets ever higher. So it's a challenge in the short term. It's difficult to stand back and watch the markets continue without participating. However, at some point, if it's proven that perhaps the Fed is wrong and that inflation is more sticky or more persistent than they anticipated, and they do finally have to try to catch up with inflation, then that could be the end of the stimulus and that could be the end of the bull market. So as investment managers, we have to be aware of that. We have to look for all the warning signs. We have to be ready to make changes to make our client portfolios more defensive.
Excellent. Great. Thank you for that. It is a very important topic for investors to be aware of as they chart their course through this extraordinary period that we're all living in. I guess my takeaway, particularly from hearing the last portion of what you had to say, is that best to proceed with caution from here in this environment. So that will do it for Steve and me. We'll be back next week with another edition of the 3Edge Week in Review. Remember, all of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.